So, for about a day this week, Canadian bond yields dropped below 3% for the first time since the Middle East conflict kicked off. Lower yields mean cheaper fixed mortgage rates are coming. Good news, right? Then the Fed opened its mouth, and just like that, gone. If you're new here, Becky Perro, independent mortgage broker. Here's the play by play. Oil has been the story. War risk pushed energy prices up, and higher energy prices feed inflation. With a possible end to that conflict in sight, oil came down. Bond yields followed it down below 3%. And that's the number that sets your 5-year fixed rate. So we had a real shot at relief. Then the US Federal Reserve held its rate. The hold wasn't the surprise, it was the tone. 9 of 18 officials now expect at least one rate hike by year end. Back in March, most of them expected cuts, so this is a hard turn. Markets reacted fast. US 5-year yields jumped, and Canada's 5-year got dragged right behind it about half as much. Now, here's where it gets frustrating. That move in our yields, it wasn't about Canada. Our economy is sluggish, to say the least. Unemployment is high. By our own numbers, the case is for a rate drop, not a hike. Nothing about Wednesday changed that. But our bond market doesn't only listen to Canada, it listens to the US. And when American traders panic about American inflation, their war fears, their tariffs, their spending, our rates get pulled along for the ride. We didn't earn this move, we imported it. That's the part that bugs me. The Bank of Canada keeps saying it acts independently, but the bond market doesn't seem to have gotten the memo. And there's one more thing nobody's pricing in properly. It's trade. Trump's been floating the idea of ending CUSMA, our free trade deal, entirely. Some signals suggest he'd rather renew it 1 year at a time than lock in a long deal. Stay with me. This one's kind of counterintuitive. If the US blows up free trade with Canada, that's bad for our economy, but it could actually force the Bank of Canada's hand towards a cut. A weaker economy needs lower rates. That might be the one thing that finally lets the Bank of Canada break away from following the Fed. So the trade fight everyone's afraid of, it could be the thing that delivers the rate relief we've been waiting for. Funny how that works. Okay, practical part. If you've been holding out, waiting for fixed rates to drop a lot more before you lock in, that bet just got riskier. The oil-led dip was real, but it's fragile. One hawkish Fed meeting wiped out most of it in an afternoon. Waiting for a bigger discount might leave you with no discount at all. So this isn't panic and lock in today. It's stop assuming the deal's going to get better if you wait. If you're inside 120 days of your renewal, get a rate hold now. A hold protects you if rates climb, and you can still take a lower rate if they fall. So there's no downside to holding one. Here's the bigger picture. Notice what this whole video is about. The Fed, bond traders, oil, trade deals. Not one of those is something you can control. You can't vote on the Fed. You can't move the oil price. All you can do is react. So let's flip it. What can you control? You can't control your rate, but you can control what your mortgage is actually doing for you. Most people's mortgage just sits there, a bill you pay, dead money for 25 years. But there's a strategy that turns the mortgage you already have into something that builds wealth while you pay it down. It's called the Smith maneuver, and it works whether rates go up, down, or sideways because it doesn't depend on the Fed cooperating. That's the stuff I actually get excited about because that part, that's yours. I've got a full video that walks through how it works, links right up there. If you ever feel like your mortgage is just a hole you pour money into, watch that one next. Now, here's the honest summary. Canada has every domestic reason to cut: a weak economy, high unemployment, easing oil, and we still can't catch a break because our rates keep getting written in a language we don't speak. You can't fix that, neither can I. But you can decide whether your mortgage just sits there or actually works for you. That's the part that's still in your hands. I'll keep watching the rates so you don't have to.